This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This lecture is on pricing. And before I get into it, I must say that there's quite a lot we need to do in this chapter. It will take a while. So I will split the lecture up. To have one great long lecture is going to be a bit silly. But first of all, we need to have a little bit of a chat before we start looking at the numbers. In that one of the most important decisions the management accountant has to make is to decide what price to charge for whatever it is we're producing. And there are various things that need to be taken into account when deciding on a selling price. And assuming you've got the notes printed out, as you should have done, you'll see on the first page, paragraph 2.1, the main areas to be considered. And it's, if you like, the 3 C's. One is the costs. I think the most obvious one of all, that whatever it is we're producing, normally, surely, you'll want to charge a price more than the cost. Then we make a profit. So clearly that's a factor determining how much our product costs. And that's part of the information we need in order to decide on the selling price. A second factor is competitors. Because again, surely, if there are other companies producing a similar product, and if they're charging $10 a unit, surely we're going to have to charge $10 a unit. All right, maybe we can charge more if we can prove our product is better. Maybe we might charge a bit less to make them buy ours instead of the competition. But certainly, we're going to have to see what price competitors are charging. And that, again, is going to be a factor in determining the selling price. The final one of the 3 C's is customers. And what I mean here is for many products, not all, but for many products, the price you charge affects how many you're going to sell. And I'm not talking about stealing business from the competition, even if we were the only producer of something. Very often, if you charge a higher price, you sell fewer units. If you charge a lower price, you sell more. And so you'll see when we come to do the numbers in full exactly how we could approach it. But suppose I've got a product which costs $10 to make. If I sell it for $15, I'm making $5 profit. Great. But maybe if I charge $15, I'm only going to sell 1,000 units. So I'm making $5 a unit profit. We're going to sell 1,000, so I'd get 5,000. But suppose, remember it cost me $10, suppose I decided instead of charging $15 and making $5 a unit, suppose I decided to only charge $12 and only make $2 a unit. Obviously I'm making a lot less profit, but suppose because of charging a lower price, we managed to sell a lot more. Maybe I could sell 5,000 units if I dropped the price. In which case, of course, even though the profit per unit is lower, the total profit ends up higher, and that in fact would be better. And so again, it's a factor we need to take into account. Are customers going to be affected in that way by different selling prices? And if so, what selling price is going to give us the best profit and therefore be the best selling price? So those are the factors, and obviously that's just for discussion type questions. But let's look at the various different calculations you can be required to do. And the first one is a very, very easy one, almost too easy. But it's over the page, what we call cost plus pricing. And although I'll go back and look at the first bit of this page afterwards, I want to go straight to the example 1, and use that to explain what we mean by full cost plus, marginal cost plus, what we mean by them, and then we can discuss briefly advantages, disadvantages. But cost plus pricing is focusing on the first of those 3 C's. It's focusing on the cost. If we know how much it costs, we want to charge more to make a profit. Look at the example with me. A very short one, a very easy one. A new product is being launched and the following costs have been estimated. Materials $10 a unit, labour $8 a unit, variable overheads $5 a unit. Fixed overheads have been estimated to be 50,000 a year and the budgeted production is 10,000 units. Calculate the selling price based on A, full cost plus 20%. What we do is this. We'll produce a cost card to see how much each unit is costing us. And here, straight off, materials, $10, labour, $8, variable overheads, $5. They want the full cost, and so we also need to bring in the fixed overheads. And of course, we need to absorb them. To absorb them, we know that the fixed overheads are 50,000 for the year. The production is 10,000 units. And so it absorbs at $5 a unit. So the total, the full cost, the absorption cost is $28 per unit. So no problem there. Well, a very standard way, certainly what used to be a very common way, is to say, right, it's costing us 28. Obviously we want to make a profit, we want to charge more. And perhaps we've got a policy of always adding on 20%. And so let's add on a profit of 20%. 20% of $28 is $5.60. And there we are. We've got a selling price as a result of $33.60. So I said, arithmetically, nice and easy, no problem. Wait till you come to some of the later exercises. But that's what full cost plus is. Get the full absorption cost, add on a percent, there's your selling price. The advantages, disadvantages, if you, the space earlier on in the page. The advantages are, of course, it's easy. That's not a very good reason for doing something, but where it can be particularly useful is if we're making lots and lots of different products, then we can have a standard policy for all of them. All our products, work out the cost, add on 20%. You know, in that sense, easy, a standard policy. And of course, subject to something I'll say later, it does guarantee a profit. I need to qualify that a little bit shortly, but fairly obviously, if this product is costing us 28 and we're selling at 33.60, then clearly there's going to be a profit. However, I think the disadvantages rather more outweigh the advantages. One, straight away, surely it ignores the competition. If there are competitors and if they're only charging, let's say $30 for the same product, then of course there's a big question mark over how are we going to be able to manage to sell any at 33.60. Equally, it ignores the effect of price on demand. And that's what I was referring to in the first bit of my discussion. That maybe if we were to charge a bit less and make less than 20% profit, we could sell a lot more. We've not even considered that. Finally, though, a huge problem is this, and it's slightly related to what I said. We've done our costings assuming that we're going to sell 10,000 units. That's the budgeted production. But of course, that's our estimate, it's a budget. What happens if we sell more? If we actually sell 20,000, then of course the fixed overheads only become $2.50 a unit. The cost becomes lower. We could afford to charge a lower price. On the other hand, if we end up selling less, if we only sold 5,000, the fixed overheads would be what, $10 a unit. The cost goes up a lot more, and we should be charging a higher price. So that's the problem, and it relates to this price demand business, that as the price is higher or lower, that's likely to mean you sell more units or less units. And if we do sell more or less than 10,000, because of the absorbing business, the cost per unit changes, and it changes everything. That's the big problem. The absorption, the charging of the fixed overheads, the fixed costs. So fine, you know, cost plus, I say nice and easy and so on, but that's the problem with full cost plus. And so there's an easy, obvious alternative, which is marginal cost plus, which is part B of the same question. It says calculate the selling price based on marginal cost plus 40%. Well, I said before, the problem with full cost plus is absorbing the fixed overheads. So why not ignore them for the moment? Just look at the marginal cost, which is another way for the variable cost. So what is the variable cost? The materials are $10, labour is $8. Variable overheads are $5. Because of that absorption problem, I won't bring in any fixed costs. We'll be paying the fixed costs whatever happens. It gives us a variable cost or a marginal cost of 23. So just following the rule, no problem. It says do it based on marginal cost plus 40%, so let's add on 40%. 40% of 23, 0.4 times 23 is $9.20. Give me a total of $32.20 as a selling price. Now, don't try and compare A and B in the sense that here we're not choosing. I'm just using this to illustrate the two different ways that people might apply cost plus approach. But marginal cost plus, look at the marginal, the variable costs, add on a percentage, we've got our selling price. And of course, we've not got that problem of how to go about absorbing the fixed overheads. Well, advantages of that. Okay, as before, it's easy. It's easy to have a standard policy for all our products. I'll say we partly remove the problem. There's no need to absorb fixed overheads. However, there are still rather big disadvantages. Same initially as with Full Cost Plus, it ignores the customers, ignores competitors, beg your pardon. It ignores the effect of the price on the demand. But another big problem, these fixed overheads. That of course, I'm saying here, oh, add on 40%, we're making $9.20 on every unit we sell. But the final profit, remember, $9.20 will be the contribution. The final profit we'll have to subtract. There are fixed overheads of 50,000. So we have to make sure that the percentage we charge is going to be enough to cover the fixed overheads to make sure we do end up making a profit. You know, if we only sell 1,000 units, all right, we get 1,000 at $9.20. But when we come to subtract the fixed overheads, we've made a great big loss. And so the fixed overhead problem hasn't gone away. You know, what percentage to add to make sure we cover the fixed overheads? So both of those approaches are actually poor approaches. They're easy to apply, and obviously if you do get any in the exam, I've shown you what to do. But for all those disadvantages, in any normal situation, it's actually very poor. I mean, you do get restaurants doing this, particularly on the wine. You know, if you ever buy a bottle of wine in a restaurant, wine which might cost $5 in a supermarket suddenly seems to cost $15 in a restaurant. You know, they're adding on 200%. There, I suppose, to an extent it can work. But for most things, because of competition, price and demand and so on, these two really aren't good approaches to use. The page also mentions opportunity cost plus. I'm ignoring that for the moment. It's something we, in fact, deal with later in another chapter. I wish I hadn't put it on that page, but still. Okay, well, I'll have a break there, but in the next lecture, we'll get on to something a bit more interesting and perhaps a bit more realistic or a bit better way of going about setting the selling price.